Welcome to This Explainer. Today, we're putting on our equity research analyst hats to objectively investigate the financial realities of Dollar General. We're going to look right past the flashy headlines and act as investigative journalists of their financial statements. We've got a seriously fascinating case study for you today. A massive retail giant going through what looks like an operational turnaround, but with a stock chart that tells a completely different story. We're going to break down the models, dig into their inventory accounting, and weigh the hidden flags to see exactly what the market might be missing. But real quick before we dive into the numbers, we need to cover our mandatory disclaimer. Disclaimer, this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's get into it. Here's our roadmap for this explainer. We'll start with the valuation disconnect. Then peel back the financials, look at the reality of their inventory and expansion, uncover some hidden flags, and wrap up with our final verdict on their economic moat and value. Section 1, the valuation disconnect. So we really need to ask a simple yet profound question here. Why on earth is a company with jumping earnings and massive expansion plans experiencing major institutional selling and a severely depressed stock price? Usually when a company's earnings surge, the stock naturally follows, but that is absolutely not happening here. The fundamentals are completely detaching from the market sentiment. Get this. Earnings per share actually surged 35.4% from their trough, climbing to $6.85, and gross margins clawed back 110 basis points. Yet, year to date, the stock slid roughly 19% down to that $119 level. It's a massive disconnect. Section 2. Peeling back the financials. To figure out why, let's objectively peel back the layers of their recent income statements. Looking at Q1 of fiscal 2026, they actually beat estimates. They posted $2 in earnings per share, comfortably above Wall Street's $189 target. Revenue rose 3.4% to $10.8 billion. And they even drove a 2% same-store sales bump fueled by higher customer traffic and larger basket sizes. Perhaps most impressively, they expanded gross margins by 65 basis points to 31.6%. They pulled this off through lower shrink and higher markups, successfully offsetting some pretty severe weather and fuel headwinds during the quarter. But despite these fundamental beats, the smart money is highly conflicted. We're looking at a real battleground stock. On one hand, you've got firms like Prospera Financial Services slashing their holdings by a massive 84.4%. Wow. But on the flip side, heavyweights like Vanguard, who, by the way, now owns over 11% of the entire company, along with Morgan Stanley and AQR Capital Management, are aggressively buying the dip. When institutional investors are this split, it tells us the risk-reward calculation isn't quite as straightforward as it seems. Section 3. Inventory and expansion reality. Let's step away from the income statement for a second and look at their physical footprint. Dollar General possesses a fascinating structural moat. They aren't trying to be a sprawling, massive supercenter. Their network consists of nearly 21,000 predominantly rural, small-format stores. In many of these communities, Dollar General is literally the primary and sometimes only convenient retail option. This hyper-local geographical positioning gives them a structural advantage over conventional retailers who rely entirely on densely populated urban centers. And guess what? They certainly aren't shrinking their footprint. They are aggressively expanding with a massive capital expenditure pipeline. We're talking about roughly 4,730 real estate projects this year alone. That includes 450 brand new U.S. stores and even entering the market down in Mexico with 10 new locations. Plus, they're running thousands of remodels under their Renovate and Elevate programs, which include bringing in cooler space for fresh produce. Now, let's talk inventory, because this is where operational efficiency shines. Thanks to strict inventory discipline and a really deliberate SKU rationalization program, they've actually scrapped over 1,500 lower-performing items. Their inventory turnover hit a multi-year high of 4.5 times. Now, a standard supermarket turns inventory maybe 12 to 16 times a year. But remember, Dollar General operates small, rural boxes located far away from big distribution centers. They absolutely have to hold deep, everyday safety stock just to avoid stockouts. So 4.5x for their specific business model is a very strong metric. It shows highly deliberate execution. But
Here's the crucial point from an accounting perspective: how they actually value that inventory. Dollar General uses LIFO, last in, first out accounting. This is incredibly important for analysts to catch. In an inflationary environment, which we have certainly been in lately, LIFO raises your reported cost of goods sold, but it lowers the value of the carried inventory on your balance sheet. Basically, it means their 4.5x turnover ratio is internally consistent, but you've got to adjust your mental models if you're trying to compare them to a competitor using FIFO.
Section 4. Hidden red and green flags.
All right, it's time to separate the real fundamental signals from all the media noise. Let's contrast some highly positive data points against some severe balance sheet headwinds. On the positive side, the green flags are pretty robust. They boast a massive 8.3% free cash flow yield, which demonstrates some real, tangible cash generation capacity. Add to that a solid 3.9% dividend yield, providing a nice floor for shareholders. And beyond just the strict financials, they're quietly modernizing. They have 7 million app users, their DG Media network generated $170 million in retail media volume, and they're rolling out an enterprise-wide AI operating system to automate their supply chain and store operations. These are classic signs of a forward-looking, cash-rich business. But conversely, the red flags explain all that heavy market skepticism we talked about earlier. The biggest elephant in the room is a staggering 178.6% debt-to-equity ratio. Because they are carrying this massive leverage load, their share buyback program is currently sitting at zero. Nothing. They simply cannot return that capital until they deleverage. And on top of that, their core lower-income consumers are facing intense pressure from persistent inflation and rising fuel costs, which completely erodes their purchasing power. Add in the intensifying competition from Walmart, who's investing heavily in price cuts, and you've got a perfect storm of macroeconomic headwinds. Section 5, Final Verdict, Moat and Value. Let's synthesize all this data into an objective verdict on Dollar General's economic moat and intrinsic value. At roughly $119.60 a share, the stock trades at a 16.9x price-to-earnings multiple. When you run the fair value estimate based on their current recovering earnings power, the models suggest an intrinsic value of roughly $139.39. That implies a solid 16.6% upside. From an economic moat perspective, that network of 21,000 rural stores provides a distinct cost advantage and a level of efficient scale that is incredibly hard for any competitors to replicate overnight. So here is our final takeaway. The quantitative models definitely suggest the stock is undervalued, and the operational turnaround is demonstrably on track with surging EPS and strong free cash flow. But those hidden debt flags and zero buybacks suggest there is still a massive storm to navigate with a highly pressured consumer base. The data is clear, but the future is fiercely contested. So which side of the trade are you on? Do your own homework, dig into those filings, and thank you so much for joining us for this explainer.